Perfect. Good afternoon, everyone. Welcome to our session on transforming payments with digital assets and distributed ledger technology. I'm Jason Park, your moderator for today. Just as a quick introduction, I lead digital asset practice at Guidehouse. It's a consulting firm to advise banks and fintechs for their digital asset journey, strategy and adoption. 2025 was an amazing year for anyone who's interested in digital asset. A lot happened, including Genius Act, many new stablecoin issuers jumping in, new product offerings bubbling up. Digital assets, stablecoins, tokenized deposits, tokenized real-world asset, they are no longer experiments. They are becoming more like real tools for faster payments, smarter liquidity, and new payment rails. At the same time, DLT is finally stepping up as spotlight infrastructure that we all pay attention now. But there are still a lot of questions and noise exist. Which digital asset model will actually win? How should banks decide where to play and then what to play? How do we build a system that are scalable and interoperable and most importantly, trusted? So that's why we're here to break this down. We have all-star lineup here. We have Ryan, Sabi, and Tony, who joined online. Do you mind giving a quick introduction of yourself to for the audience as we get started?
Yeah, happy to kick it off, Jason. So firstly, really happy to be here. Thank you for having me here today. Sabi Bazard from Deutsche Bank. I lead essentially our digital assets efforts across our corporate bank and investment bank. I've been doing that for a few years. I've been at the bank about 15 years now, and really looking forward to the discussion.
All right. Ryan?
Ryan Rugg, head of digital assets for Citi's TTS business. Been at the organization 3 years. Had the pleasure of working with Tony McLaughlin as well at Citi, but have been in and around this space for a decade. I joined from IBM, where I ran their blockchain practice. So advised a lot of banks, central banks, fintechs on this space, on building, deploying regulatory, compliant systems. And then prior to that, worked for a fintech startup for 5 years that we built our own protocol called R3 and built Corda. So again, have seen several ebbs and flows in this space and looking forward to sharing our journey in the past, but also what we're doing at Citi currently.
All right. Last but not least, Tony.
Thank you. I'm Tony McLaughlin. I was previously at Citibank. I've done nothing in my career except work in payments for banks, so BAFT feels like home. On Christmas Eve in 24, I decided to make the jump from so-called TradFi into digital assets full-time, and I'm now the founder and CEO of a company called Ubix Inc., which is a clearing system for tokenized money.
All right. Thank you so much. So we'll kick off with a quick audience poll to just gauge where you are in your digital asset journey, and then we'll jump straight into the discussion. So let's get started with the poll. I know everyone has the Slido access. Okay, the first question, very easy. Do you know the difference between the digital assets, whether it be stablecoin, tokenized deposit, and the distributed ledger technology itself? All right. There's some yes and no's. Yeah. I guess there are more awareness about those assets versus DLT as in technology, which we'll definitely cover during our discussions. All right. So I think we're 2/3, 1/3 of yes or no, which is a great start. Okay. Can we move on to the next question? All right. What is your organization's overall interest in digital asset / DLT? 1 being lowest, 5 being highest. This is just overall interest. You don't have to have a live product that's flying and then your clients are using. It's just the overall interest. it seems like more than 70, 95% is mid to high, with highest as 40%, which is great, encouraging. I'm surprised that there's one, and well, actually two responses. That's 1 and 2, which is okay. All right. I think we can move on to the next question then. The next one and the final one. What's your organization's current readiness to adopt digital asset? A, no dedicated teams or working group yet, like you're just getting started of entertaining with different ideas. B, strategy and roadmap defined, which is probably the next step. C, you have completed or actually started the proof of concept or pilot. D, live product and offering that clients are using. Yeah, I find this question pretty interesting. Yeah,
very much so.
And it's, what do you think? It's
Pretty split.
is this like as expected, or is it anything surprise you?
I think the live product was around 25%, so
Right.
a quarter of the people in the room with a live product. There's so many different types of digital assets in
Right.
regards to, are you doing crypto, are you doing tokenized deposits, are you doing stable coins? I find that fascinating.
Yeah. So, I mean, this look around you, like this is where we are right now, which I think it's actually good news that there are enough of us who actually started earlier in the journey of developing digital asset using DLT, but some of our actually 26% has no dedicated teams or working group yet. So I think this is a great place where we can learn from each other and kind of join the journey together. All right, so with that, let's dive into some of the questions. All right. So the first question is, what is your view on different types of digital assets? Because there are a lot of misunderstanding that it's digital asset stablecoin, or is it stablecoin tokenized deposit? So what's your view? Like stablecoin, tokenized deposit, tokenized real world asset, like what challenges are they really addressing? Maybe I can start with Sabi.
Yeah, so I think I was going to cover maybe a little bit about stablecoins first. And from my perspective, stablecoins, they're a 24/7 form of money. They're programmable, essentially borderless, and ensure settlement finality. So they have, in essence, become the de facto on-chain digital asset payment mechanism for the crypto industry. That's really where they've been born and brought up. That's where they were developed. And I think the big question right now that's on the mind of many people is how far can they permeate the traditional banking sector, right? Can they really scale up in the traditional payment space, trade settlement space, treasury management space, right? And so I think that's the bit that remains to be seen, but that's where they've come from. That's where they've certainly got some level of momentum. The second part of your question about the challenges that they're meant to be solving, well, typically speaking, the challenges that were faced in the crypto industry was there was a need to move liquidity around quickly across multiple venues. Banks didn't readily facilitate that because there were cutoff times, there were processing delays. So this form of money helped kind of get over those hurdles. That was one important piece. The other piece has been that in certain jurisdictions, liquidity in certain currencies has been hard to come by. So this provided a mechanism to ensure settlement in what was predominantly USD. 99% or so of stablecoins are still USD denominated. So those were the real problems that they've been trying to solve. And I think you can see on the crypto side, as I said, some real traction. Now we're at the precipice of figuring out to what extent they can permeate that traditional space.
Yeah. Thank you. How about tokenized deposit and real world assets, Ryan? Can you shed a light on that?
Yeah, so just to add on to that, if you look at the volumes, still 85-90% of stablecoins are primarily used in the retail space, not institution. And you think of kind of why they were invented, why USDC came into be back in 2018 it was really that crypto was so volatile, and you needed cash on ledger to be able to have that fungibility between asset and cash. In this case, it was a stable coin. And you've seen the use cases to continue to grow in this space, and corporate adoption, I would say, is still on the lower end of the side. You know, from my IBM days, I advised a lot of different banks as well as the corporates out there. You know, the expertise internally to be able to host nodes, manage wallets, key management. There's a lot of, and also monitoring a network that is on 24/7, 365 was very difficult. So, you know, fast forward, you know, stablecoins are one, you know, form of, you know, fiat on chain. Another form that you asked about was tokenized deposits. And, you know, so 3 years ago, you know, when I joined Citi, we did a survey with some of our top clients, what was like one of their main pain points. And it was real-time liquidity and payments, being able to provide that 24/7, 365 frictionless movement of money, regardless holidays, weekends, cutoff times. So really starting with that, we looked at multiple different types of technology. We ended up landing on a blockchain only because we believe, like our mission statement is that to create the future of networks will be multi-bank, multi-currency, multi-border, providing always on, and multi-asset, and always providing on liquidity payments and full fungibility between assets. So we started building what is now called Citi Token Service, which is our tokenized deposit solution. We're live in 5 different branches, US, UK, Dublin, Hong Kong, and Singapore, and we targeted our largest money hubs. You know, Citi moves anywhere from $4 to $5 trillion a day, but we do have cutoffs, right? So if it's 5 p.m. on Friday in New York, it's 5 a.m. in Singapore. So typically our large multinationals and treasurers would have to forecast and send money in advance of this cutoff. Or for instance, we had a client that during Chinese New Year, Singapore was closed, but they wanted to invest in US equities and bonds. And typically they'd have to forecast for the purchases as well as our margin calls. Now they were able to do it real time. So completely frictionlessly be able to move that. And some of the core tenets we took, and you know, from my past experience, like learning, like, you know, when I was at IBM, I advised a different bank where clients had to open new accounts, they had to transfer their top deposits into tokens. And the feedback that we got was like, we have hundreds, if not thousands of accounts. We don't want additional accounts. We don't want additional operational burden. We just want the pure, like, underlying, you know, ability to move money frictionlessly across the globe. So taking in some of those core designs into CTS, we designed a platform where we completely obfuscate the complexity of a blockchain. Like, our clients don't even know that they're using a blockchain. Like, it's a drop-down box. It's just another payment type or just another way to move liquidity, where we'll mint a token in New York, we'll send it to Singapore, we'll burn it. So it's cash for cash in their accounts. So some of these early decisions on that, but tokenized deposits are just a representation of our clients' money that we tokenize and move. You know, there's, unlike stable coins, there's no reserves, there's no one-for-one backing, it's just client money. It has all the traditional KYC, AML, BSA. You know, I'll say building this the last couple of years, going through numerous internal and external approvals, like it goes through all the traditional like approvals that a normal product goes through, but was even more enhanced because we were using, I would say, emerging technology. But we really focused on like what was the pain point that we were solving, less on, you know, the technology, because, you know, having built, done 500 plus POCs in my career, for a long time, like I felt like blockchain was like a hammer looking for a nail. Like, what was the real pain point that we were solving? And that's what we focused on, taking the complexity away from our clients and just delivering that frictionless movement of fiat around the globe. And, you know, we're live in USD and just added Euro. So now being able to provide that multi-currency aspect as well.
That's quite amazing. And then that kind of reminds me why we're all like sitting here today. It's to transform payments with digital assets. It's not about how technology will transform other things, but really focusing on clients' problem, like pain points, and then technology comes next. So the next question is, so it's kind of, you know, answering this, you know, one of the polls questions, how does the DLT, distributed ledger technology, fit in with all of this? Is how can DLT can be differentiated from the digital asset itself? Tony, can you shed a light on this question?
Yeah, sure. If the audience will forgive me, the best way of understanding this is to take a kind of first principles approach and ask ourselves what a DLT really is. And I think the best way of thinking about a DLT is it is a any blockchain is a who owns what machine. So if everyone in the room had a bag of different colored beads, that could be the initial state of a system where we want to know who owns what at the current state. But if each person traded those beans with other people in the room throughout the day, we would like to keep track of the state of that system at any given time. So a blockchain or a DLT is nothing more than a state machine that keeps track of who owns which colored beads at each instance in time. Now, then we come on to what are the digital assets? Those are the beads. So if you imagine that you're sitting there with a bag full of blue, green, and red beads, the blue beads could represent a tokenized deposit. The green beads could represent a stable coin. The purple beads could represent a tokenized money market fund. A green bead could represent a tokenized bond. The beautiful thing about the blockchain is it keeps track of the state of who owns which bead across any arbitrary asset. And this is something fundamental because up until now, all of the rails that we've built have been special purpose. So Fedwire, for example, only does one thing. It only keeps track of one type of bead, central bank money in US dollars. And that's true for lots of the financial infrastructure that we've built. We've built silos. So securities CSDs track one flavor of bead or one family of beads. And the promise of DLT is that they provide general purpose rails so that we can keep track of who owns what and who owes what as people transact. This is a very powerful concept.
Thank you. So we just covered a bit of introductory of different types of assets, but will there be one form or one type of digital asset that's just reigns superior over another, or how are banks finding the revenue model using those different digital assets? Any insights on those?
The way that we've kind of approached our strategy is build by partner in this space. So, I described City Token Services is one of the products that we build. We're partnering. We partnered with Coinbase to be able to provide the on-off ramps for stablecoins. We view this as another payment type. If our clients want to be able to use it, we want to enable them. And then we also, when I say buy, it's really invest a lot in this space, and we're investing in Finality and BVNK and several of these different startups in these space that are, working with different, central banks in regards to building out these networks. Because I think one thing, as Tony described, the various beads out there, they need to be able to interoperate seamlessly. No one wants just a City token. Interoperability is key in this space and being able to provide that. And one of the promises or one of the very strong attributes of this technology is we're moving away from an account construct where you have a cash account and you have an investment account to you have a wallet. And so think about a use case where you're a large multinational treasurer. You're now able to move your money seamlessly from Singapore to US in under a minute. Then you're able to invest in a tokenized money market fund, and there's several asset managers out there that are issuing the BlackRock's, Fidelity's, T. Rowe's of the world, and you can earn intraday yield. So there's no T+1 settlement, there's no delay. That whole latency from the system is going away, and that's what this core technology provides. And for the longest time, back at R3, we were tokenizing bonds, equities, real estate, all different various types of real world assets, but there was never cash on ledger. So we always had to go back to the traditional rails to settle, and then you still had kind of that latency in it. Well, now you're seeing the proliferation of this cash on ledger in various forms that can truly give you that multi-asset network that really changes the way that financial services are done.
That's great. So seems like in the industry, there are proven use cases that we validated that it's actually working in real life. And then that comes with the question around scalability. How can we scale it from, so we passed the 0 to 1. How do we do it from 1 to 100? Any insights on like how we actually do the scale up?
Yeah, so to be honest, we've got a question on the screen that I think talks to it really, really well. I think there's always three things that you need for that. And I think part of the answer to scale is we spent a lot of time, I think Ryan referred to a lot of experimentation that's happened. The industry spent a lot of time doing experimentation rather than thinking about building that industry-grade solution. So I think that's one thing that's actually shifted, I think, across all industry participants, that real desire to build something that's industry-grade that will scale. But typically there are three things. One is that regulatory clarity. You absolutely need to have clarity, especially for a large, highly regulated bank. Before it enters this space, it needs to understand the rules in which it's entering. And I think one of the challenges, of course, is that a lot of what we're talking about is global in nature. So this is not just about having regulations in one country out of the many countries that some of the larger GSIBs operate in, but it's actually getting a broad consensus on the regulation. That regulation will never be identical. It isn't today in the TradFi space, so it's hard to imagine that in this space, all of a sudden, everyone's going to agree on one outline of regulation and simply adopt it. That's never going to happen. But I think the broad brush and broad principles need to be such that players can enter the market with a level of certainty. And I think that until recently, that was missing. There is a bit of a nuance here because we talked about the different types of assets, Jason. And I think broadly speaking, again, you can split hairs a little bit, but broadly speaking, for tokenized deposits, there was a lot less work to do on the regulatory side because by and large, they're considered as regular deposits with a different type of technology overlay on top, which is actually a positive, not a negative, right? Because it just allows a better and greater understanding. I think on some of the newer assets like stablecoins, that's where there obviously was regulatory uncertainty. And I think a lot of jurisdictions, Europe, for example, under MiCA, came out with regulation that was quite clear. Obviously, we've had the Genius Act in the US, and there's many other jurisdictions, Hong Kong, Singapore, Dubai, et cetera, that have established those regulations. So that regulatory clarity is absolutely critical for scale. Without that, you're never going to get out of very small scale items. The second is interoperability. So one of the other challenges that you end up having is every industry participant creates their own island, and that island then does not talk to everyone else's island. And what you've actually done is split liquidity and make the problem worse rather than better. So interoperability has been a long-standing problem. I think there's been lots of developments in the industry that are seeking to resolve that, either link different blockchains together or new technologies that have come up since then. And even developments on standards, I think, has accelerated. So I think there's a lot more to do in that interoperability piece, but I think we made very, very strong strides. And then the final piece is integration. That's really critical, right? So nobody's going to stand up a completely new infrastructure and stack. And I think Ryan talked about the fact that clients aren't that interested in the technology. That's absolutely true. Nobody really cares about how your mobile phone works. It just works, right? So whatever the technology is behind it, as long as it works, that's what matters. It's the same principle here. So that integration with legacy systems, legacy processes is really, really important. Without that, it's very difficult to create that user experience for a client that really works. And just take the simple example of things like ERP systems, right? No one's going to completely re-architect the ERP systems they run because there's a stable coin, right? That's just not going to work, or tokenized deposit. You need some way to integrate with those legacy systems so you create that seamless experience.
Those are great insights. So basically, the regulatory clarity across the board, across different regions, and then also the integration to the existing core banking system and then other ERP systems. But also, probably the next question is about the interoperability, which is really the key to maximize the value of the blockchain or any of the DLT related systems and offerings. So what can we do to ensure the interoperability? And then I think we have a great panelist for that who is in the front and center to ensure the interoperability. So Tony, would you mind sharing a bit of your thoughts on that?
Sure. look, the whole purpose of the company that I formed is to achieve that interoperability, and the fundamental primitive that needs to be delivered is the ability for the tokens to be turned into cash and the cash to be turned into tokens in a clearing mode, not in an exchange mode. And that's indeed exactly what Ubix is doing. Is just to make this concrete. Let's say that Sabi's bank, Deutsche Bank, wants to offer a new service to its clients to receive stablecoins and tokenized deposits. Let's say that the tokenized deposits come from Citibank. Let's say that the stablecoins come from Circle. So if you can imagine the situation, Sabi will provide a wallet to his customers. The tokenized deposit and the stablecoin will be transported over, could be completely different blockchains, into the wallet that Sabi provides to his customers. And then probably what Sabi's customer wants is to have their account at Deutsche Bank credited, perhaps in euros. And so the operation that Sabi has to perform is to turn those tokens into cash. Now, there's two ways of doing it. One way of doing it is that Sabi could sell those tokens through an exchange. And if he did that, he wouldn't be guaranteed par value redemption, and therefore neither would his clients. And he would also have counterparty risk against the exchange. The other way of doing it, and I think this is the real key, and I hope this resonates with a number of folks in the BAFT audience. I hope there's a few old timers out there who know about check clearing, and even international cash letter might ring a bell for a few people. But in today's world, Sabi's bank is receiving US dollar checks, and he's sending them through his US dollar clearing system, through his US, actually, probably Deutsche Bank does its own US dollar clearing. But those checks find themselves flowing through the US check clearing system and are presented to the issuer for payment. And we think that that's a fantastic pattern for dealing with stablecoins and tokenized deposits. So this is one glimpse, I think, into the future. Just like in cards, there are thousands of issuers. But when you take, any one of you can travel to Japan and walk into a hotel and pay your hotel bill with your cards, and they're all issued by different issuers. And here's the critical thing. The hotel doesn't care about the issuer, because there's a scheme that drives interoperability, Visa or MasterCard. And in the world of tokenized money, of tokenized deposits and stablecoins, tokenized money market funds, there's also a need for a scheme that, or a system that means that at the point of use, the issuer doesn't matter. So this is where I confidently predict that we're going. There will be thousands of different tokens from lots of different issuers. They will be circulating on lots of different blockchains, but most likely every bank and fintech on the planet will have wallets connected to multiple blockchains, and they will be able to readily process them on behalf of their customers. This is the conviction that led to me quitting my job at Citibank on Christmas Eve. I should have waited an extra month, because the bonuses at Citibank get paid at the end of January. But my conviction was so great in this future that I walked away from my bonus. So I've got skin in the game that this prediction is true.
Thank you, Tony. I think we're all on the same boat, or dreaming the same dream in terms of multi-asset, multi-type of digital asset, multi-type, different types of blockchain network, all interoperable across the board. I think that's where the real kind of value and then the power of blockchain and distributed ledger technology actually realized. So kind of thinking about road forward, if it's a bank, like how does a bank decide which type of digital asset they should adopt? I think we've already talked about the right answer, but do they adopt the multiple forms, or do they should focus on just one thing and after another? Any thoughts around this?
Yeah, so I think kind of implicit in your question is, there is no one winner of this. I think that's the first question, right? Is one going to kill the others? I think the answer is no, right? The reality is stablecoins are there today, and they seem to be growing. I agree with Ryan that the actual volume on TradFi payments, on kind of real-world payments, is very, very limited today. That question about whether they will scale is yet to be seen. But the point is that they do exist and they do work, right? So I think they also can't be dismissed outright, and that's why you see, for example, a number of banks where one of those banks that are involved at looking at the potential issuance of a stablecoin. So there's 9 GSIBs that announced they were looking at that later last year. So that piece of work is continuing, and we'll see where that goes. So I think the answer is absolutely there'll be coexistence. I think the use case will depend very much on what you're trying to achieve. So there's a few different factors. I think that regulatory clarity we talked about earlier becomes important. I think the corridors in which you wish to operate becomes important, because there's some corridors where traditional payment schemes or traditional payment setups, correspondent banking, for example, doesn't work quite so well, either because the rails in those locations aren't developed as well, the local infrastructure doesn't exist, or that market potentially is just not attractive to certain players. So that might be a good place where a stablecoin could potentially offer value. I think on the other side, where you've got a real need for institutional grade, large value payments, trade settlement, I think that naturally tends to have a tilt more towards that tokenized deposit world, given the fact that it leverages off a very traditional banking style of working, the deposit insurance that sits behind it, the yield-bearing nature as deposits provide, I think naturally provide that tilt. So I think the answers, both will coexist. I think it will come down to those very specifics on corridors and purpose.
Yes. In terms of future use cases, as Ryan just introduced, there are cross-border payments that's already live. Those MNCs, treasurers are actually using DLT to move their funds freely, frictionlessly. But beyond that, what would be the most kind of exciting use case for the next 2-3 years, or 3 to 5 years? What are some of those use cases that excites you?
I think for me, I spoke a little bit about it. Now that you have, cash on ledger in forms of stable coins and tokenized deposits and CBDC in different country, it's really being able to, again, what this technology can do is multi-asset. And you've seen, the proliferation of tokenized money market funds, CP, and commercial paper, and you're starting to see the complexity of the assets start to move up the chain. So all this latency that we have in the system is really going to go away. And I think that's what really excites me. It's we're rethinking the way that financial services operates. And I see some of the questions, and it's going to make a lot of companies rethink their business models. But for instance, Citi's been around for 200 plus years, and we've continued to innovate in this space. And we're going to have to continue to innovate. And it's digital assets is one of those things that we're past that point where, oh, it'll go away eventually. It's like standing on the beach and yelling at the tide to stop. There's legislation out there, the Genius passed, Clarity's in the house right now. So there's a lot of things that are going on, and that regular legislative and regulatory clarity gives highly regulated institutions like the swim lanes. We don't ask for forgiveness, right? We ask for permission. We're not going to do something unless it's regulatory approved and it's very clear set of roads. So we even with our tokenized deposits, we were engaged frequently in numerous meetings with all of our regulators across the globe. Every branch we launched with the regulator in the region to make sure that that safety and soundness and scalability that we have, and we act as a corresponding bank for probably many of you in the audience, that we're providing that safety and soundness. Just because this is a new technology and a new asset class and a new way to move money, we still want to ensure that safety. And that's actually one of my kind of thoughts. What we're going to see across the industry this year is really consolidation. Now that you're starting to see these guardrails emerge, not just in the US, globally in Europe and Asia as well, about what's permissible and what's not, and the level of audit and like what they have to do for the reserves and the regulatory, to be regulatory compliant, you're going to see consolidation across the industry. You've already seen kind of stagnation in stable coins, so you're not going to see all these random coins popping up. If they know to be regulatory compliant, they're going to have to do all the reporting. So I think it's actually good for the industry that we're having kind of that safety and soundness kind of be to raise all standards across.
Absolutely. And we're here with two representatives from banks, and then also Tony from UBIX. But there are other participants in this ecosystem, right? Stablecoin issuers, there's exchanges, and others. Do you think it's going to be a winner takes it all situation after, let's say, 3 to 5 years, or is it going to be the other way around? And then I'll probably ask this question to Tony, who is who's holding the neutral position. So Tony, if you can shed light on this, that'd be great.
Well, given the audience, I think it's most relevant to talk about how banks can win. And look, there's a more nuanced answer than I'm about to give. And if you'd like to hear that, please reach out to me on LinkedIn and we can discuss it in more detail. But here's the simple version. If you believe that we're entering into a world of tokens and chains, then the next thing you might ask yourself is, do we know which token will win? Do we know which chain will win? And the answer to both of those questions is, well, first of all, we are entering into a world of tokens and chains, but we don't know which token will win and we don't know which chain will win. The thing that you can do to future-proof your institution, the thing that covers you for the broadest range of contingencies at the lowest cost, is to equip your institution with a wallet infrastructure. The wallet infrastructures today can connect into any chain. So once they're in any chain, they can transact on any wallet. You might consider this your insurance policy. So for your bank to be future-proof, it has to be able to straddle the TradFi, the traditional world, the traditional rails, the world of bank accounts, and the world of tokens and chains. And the first thing for every institution to do, don't issue something. Don't issue a stable coin. Don't issue a tokenized deposit before you have a wallet infrastructure. It's the lowest common denominator. And I beg you to consider this. If you don't have the ability to offer your customers wallets, you simply cut off all of the optionality that might appear in this world of tokens and chains. For the cost of probably no more than, I would say, a couple of $100,000 a year, maybe half a million dollars a year, your institution can have a wallet infrastructure. And the day after you've implemented that, I would put to you that you can breathe a sigh of relief. Banks can win in this space, but they must be able to transact in the world of tokens, chains, and wallets.
Yes. Thank you, Tony. Can't agree more with the importance of the wallet, because if you think about the clients or customers, it's almost like that touch point where, whether it's a bank or wallet provider, it's the very important touch point where you interact with clients. So without a wallet, you don't interact with your client, and clients cannot access to the digital wallet, so a digital asset. I think we have just time for one question from Slido. Let me ask you this, because I think this might resonate many of you sitting here. So regional banks that don't have the large bank scale balance sheet and global networks and then resources, what is the practical first step into the digital asset? And then also, what should they not try to build?
I'm happy to start. So I advised multiple regional banks while I was at IBM, and one of the key things was about partnerships. So as I said, our strategy is build, buy, partner, and it kind of starts from, I would say, the most complex, expensive timely, to build, to time, to get regulatory approval, legislative clarity, all that, versus partnering. There's a lot of great companies out there that you could partner with, but it's really boils down to like, what pain point are you trying to solve, right? Are you trying to offer multi-asset to your clients, a new asset? Are you trying to do payments via stablecoins? So, and based on that will help you kind of decide who you want to partner with, and then buying and investing in these companies that you think could be a potential, next network or, infrastructure play. Where I sit within the organization, every investment we have to dog food, right? In the sense that we actually have to use it if we put money into it. So it could be part of your strategy as well.
All right. I think with that, we're on time. Thank you, everyone, for joining today's discussion. And big thank you to Ryan, Sabi, and Tony for the insights and the energy today. I think one key takeaway for me that's very clear is there's no one winner. There's no one digital asset that's going to survive. It's all about the network impact and interoperability. So we all have pieces of the works to do to collaborate and then push this beautiful infrastructure and technology together, to forward the future of finance. Thank you, everyone, for joining today, and then hope you enjoy the rest of the conference.